Welcome to this week's Wealthologist. Now, I realize it hardly feels like new news because we all experienced last month together. But last month, the US stock market had its worst month since March of 2020. Now, we got to remember, that's when the whole world shut down due to the pandemic. But this past April, well, the S&P dropped 8.8%. The Dow down 4.9%, and the NASDAQ down 13.3%, which that marks that index's worst month since 2008. But the world's not shut down right now, and there's not really a financial meltdown. So why are stocks acting as if we're in crisis? Well, we talked about this last week. The primary headwind for growth right now, it's the Fed. It's their plan to increase interest rates in order to cool inflation, which has really gotten out of hand. Now, this hawkish turn has been especially painful for those high-flying tech companies that did really well during the pandemic, and they become much less attractive as interest rates have moved higher. For example, look at Zoom. They fell 82% from their all-time high, and Roku down 80%, and Coinbase down 67%. Now, there's a secondary concern as well, which that's the supply chain bottlenecks. Quite frankly, those are still stinging corporate giants in America. Now, with China locking down cities at the first trace of COVID, American companies whose products are made in Chinese factories, well, quite frankly, they're just not able to fulfill orders, and they're not able to make money. Thus, they're losing money. Now, on top of all of that, we know that the war in Ukraine has introduced big challenges for companies across virtually every sector. So the big picture, we need to understand that when the stock market plunged in March of 2020, it was followed by skyrocketing growth, which was really because of printing of money and everything opening back up shortly afterwards. Do not expect rapid recovery this time. Now, we got to keep in mind that the economy is fueled by spending by consumers and businesses. 88% of that comes from consumer and business spending, and both of those still remain strong, and they're really supported by trillions of dollars on the sidelines. And the other thing is corporate earnings are looking pretty darn good this quarter as well. So the thing is it time to panic? Not time to panic. Is it time to relax? Definitely no. Rather, I think it's time to be vigilant and continue to work the plan as we always do. We wish you well and encourage you to reach out with any questions or concerns that you might have.